When you look at these big sell-offs and you look at where rates are sitting right now, particularly the 10-year, albeit off the lows, but still under 0.7%, I mean, can banks really recover from this?
Yeah, I mean, yesterday was clearly one for the record books. Last week we were struggling kind of with the rate cut and obviously fears around coronavirus. So we did see a good amount of selling post-rate cut. I think banks are down about 20% in the last 3 or 4 sessions. So that isn't necessarily something new. But yesterday, for the most part, we saw a bunch of selling from short sellers, from long sellers, and a bid really didn't materially develop throughout the day. And that kind of speaks to what you were talking about earlier. You have coronavirus concerns, you have low rates, and then the big new news was the oil price wars over the weekend, which was kind of felt like the final blow for the financials yesterday, especially the banks. The rates, plunged down 35, 40 basis points, and investors are starting to make the bet that a recession could potentially be near.
And so what would happen to the sector if we look at a recession and if we look at Fed intervention almost
Sure.
tapping out? I mean, how many more tools do they have in their toolbox? Although we are expecting another big cut, but gosh, this last one, surprise as it was, didn't do much.
Yeah, no, it didn't do much. And, lower rates, banks are not necessarily built to handle zero interest rates, as you can see in Europe and Japan. So our research department about 2 weeks ago did a piece that talked about a less adverse case for the banks, which would be 1 rate cut and slower growth, where we avoid a recession, and then a more severe approach, which would be 5 rate cuts, 50 basis point 10-year, and close to a zero interest rate policy. So I don't think many people thought we'd go to that place in 2 weeks, but this is kind of where we're at right now. So we stress tested the banks, and we feel that in a more adverse scenario, the median impact EPS could be about 25%. So I feel that a lot of the banks have kind of adjusted to that already. I'm not saying that there's not issues out there and we can't go lower, but I feel like, some of the requests we've gotten in the last couple of days for work around the banks, people want severe stress test, analysis. They want work on European and Japanese banks, which trade at 50% of book value in some cases. So we're starting to see investors really, I don't want to say push the panic button, but really prepare and hunker down for adverse scenarios in the sector.
So if you're talking about adverse scenarios, you're talking about these 2 different scenarios, the second of which more severe. You didn't think we'd get there, but it looks like we are.
Yep.
You're building in recession.
Yes. I mean, I think if you're going to go to that place in scenario 2, investors are clearly building in the recession probability. And we put a couple different analysis out there for investors to express how they feel and look at the work. And, the market is voting right now with what they feel.
And so what do you do if this is the scenario?
Yeah,
what's your recommendation?
So it's a little bit, a lot of folks are trying to compare it to the financial crisis. It's a little bit different in the sense that the banks' balance sheets are a lot more well capitalized, a little bit more diversified, not as much exposure to the mortgage market. Even from 2016, banks have tightened up their lending standards on oil and gas and hospitality and travel. So the lending standards we feel are higher and better. So there's good capital return stories out there. There's conservative banks that have historically made good loans. So, I mean, we feel that if investors have a great opportunity right now to move to quality, because there's a lot of trophies on sale in the banking sector right now.